Ryan, a lot of people are out trying to find a good mortgage, and a lot of times they're trying to find a good mortgage broker in order to find them that good mortgage. I know that sometimes you'll get calls that are come into Cobalt, and it's, hey, I'm looking for something, I'm looking for your best 30-year fixed rate. And that doesn't really work that well as a way to shop for a loan, or probably somebody you can trust as far as a loan officer. Does it?
I don't think it does. I mean, the same thing as finding a real estate agent, a good financial planner, or a good mortgage lender is the best. The best way you can go is get great referrals from trusted friends and people who've had experience with those professionals. And that's really probably, from my side, 80 to 90% of the business that I get. The other 5 to 10 is people calling randomly, which is really rare, and I don't think is an efficient way to go about it. So yeah, I think getting a referral from people you trust who've had a good experience with true professionals, that's always your best bet to find somebody to help you either refinance or help you on the mortgage side to buy a house, without a doubt.
Sure. No, Tom, a lot of people go in to get a financial plan, and typically, it's a little bit deeper of a plan and relationship where mortgages seem to be transactional. How involved do you tend to think that mortgages are with financial plans? And then also, do your clients that come to you for financial planning, do they have additional questions on mortgages? How do you see that?
I see it as being a really important part of their financial plan. And a lot of times people just aren't aware that they can get a much better rate, they can get a much better loan. And so I look at it as if they can save X amount of dollars per month on their mortgage, they could either keep their same mortgage payment and pay off their house faster. They could invest the difference and earn some money on that. But they can really drastically change their financial situation depending on what type of loan they have. I've been meeting with people lately that have had 6% 30-year fixes that don't even realize that they could qualify, one, for a lower mortgage, or two, that even realize that rates were that much lower for them. So you start having a $300,000, $400,000, $500,000 loan, saving a few percentage points. That's a lot of money.
How do you help? How do you bridge that gap? Do you refer people out? Is it something how do you bridge that gap? And then I guess, do you have questions that your clients have that you can ask Ryan?
Yeah. So how I bridge the gap, because we are looking at everything, and I will actually do a lot of the work for the mortgage person, meaning I'll run some amortization schedules. I'll show them how they'll be better off financially. And then once it makes sense to them, I'll usually refer them out to one or two mortgage professionals in our network and just say, I think it'd be important for you to talk to them. Because a lot of times they say, should I just refinance with my bank? And I'm like, that is an option. People assume that just because they have their loan with a large bank, that they're going to get a great deal, and they're told it's no cost and so forth. And I tell them, hey, just so you know, it's usually never no cost. And sometimes a mortgage professional can actually find a better loan for you specifically that a bank may not offer. But, a lot of times when I'll get emails from clients or calls, or if I'm talking about it, and they'll just ask, I got an email or I got a letter in the mail and it says I can save 0.5% or whatever the number is. And what I'm curious, Ryan, is there like a general rule of thumb for how much you need to save on your, interest rate in order to make sense to refinance? I know that the general rule of thumb used to be 1%, but I've done enough math. It feels like it's less than that. So maybe you have some kind of input on that.
Yeah, that's a great question. We deal with that every day. And from my perspective, it never really comes back down to a certain percentage that you're saving. It's the overall, like any financial plan, is what is the overall objective with your home and your mortgage? So if somebody tells me they're only going to be in their home for 2 years, then the equation of what they need to save to offset the cost of refinancing is different.
Correct.
But if they're pretty sure they're going to be in the home for 8 to 10 years or whatever that period of time is, then it just comes down to the finances of it. So even if they're only saving 0.5 point and that equals $200 a month, that's $2,400 a year. And if it costs $3,000 to refinance, it's a payback of about 13 or 14 months. So anything after that, it makes sense. So everybody's situation is a little bit different. And what are they going to do with the savings, whether they're going to pay down the balance, whether they're going to put money into education, to savings, to retirement, and what kind of return you can get on that money saved. All those things come to an equation. But, even if it's $100 a month, that's $1,200 a year.
Right. That's a lot. I mean, that adds up.
Absolutely. So it's all the bigger picture is really what people need to look at, not a specific rule of thumb on percentage points.
Yeah, I mean, there's loans that I've done or we've done that, where people save $50 a month. It's like, well, do you want to save $600 a year to do some paperwork? And, if it's the no-cost loan, which are also possible, all of a sudden you're like, well, do you want to, it's your money. Do you want to save $600 a year? And sometimes people are like, well, it's not worth the paperwork. And sometimes it's like, well, do you travel? Here's 2 plane tickets every year. Just get your paperwork done.
We have commercials for insurance where they're touting, save $100 a year for insurance, and that seems to be like a big deal. That's a whole marketing campaign. So maybe we're just marketing our business a little bit wrong.
And
you can save $4 by switching your mortgage costs.
I agree, though. I think, I always tell people it's the small things that add up over time. So if you're doing enough small things, you save $50 or $100 or $150 on your mortgage, and then you save some money on your insurance or whatever these other buckets are, you spend that much less. All those little things over a long period of time add up to a big pot of money.
That'd be interesting to run an ad campaign like the Geico mortgage ad.
Totally.
Like, hey, 15 minutes can save you 20% on your mortgage payment.
$10 a month is $120 a year. That's a payoff of 27 years.
Yeah.
Last 3 years, I'll get you, though. It's going to be good.
I have another question, Ryan.
Yeah.
Since you guys are in your own little world. So because interest rates are so much lower, so, a lot of the kind of, once again, rules of thumb, and I get that they're just rules of thumb, but, when the mortgages were 6% for a 30-year fix, and you kind of look at the math, well, now at 3.5%, 4%, you could obviously you can have a lot higher mortgage balance and have a similar payment. Right? Mm-hmm. So, let's say you had a $500,000 loan at 6%. You could probably now have a $650,000 loan at 3.5%. Do you still discourage people to do that? So if their payments are going to be about the same as it would have been because it's a higher loan balance, I've found that people sometimes get worried about the amount of loan balance, even though their payment was exactly the same as it would have been on a lower balance with a higher rate. Does that make sense?
So like pulling the money out and investing it?
No. Just when they're looking at a house. So, 5, 6, 7 years ago when 30-year fixes were at 6%, you could afford a $500,000 mortgage. Now with loans at their interest rates at 3.5%, they may be able to afford a 6.5%, a $650,000 mortgage. Do you see people?
Yeah, I get the question. I don't think, at least in my experience, I've never counseled people down that line as far as balancing mortgage amount with objectives. I look at the whole picture and basically, because everybody's different, and what a lender is willing to approve somebody at.
Yeah,
even in today's world where it's supposed to be a lot more stringent, even though someone can get approved for X amount, that doesn't mean it's in their best interest to go that high.
Absolutely.
Because what lenders look at is a lot of intangibles that don't go into the qualifications of applying for a mortgage. Mm-hmm. So I think it's more based on their overall, again, financial planning is a big part of having those conversations with our clients and understanding kind of their current financial position, not just what the lenders look for, but what are all the things outside of that. Right. Somebody could have 7 kids and their expenses simply for, food and diapers and everything else could be $3,000 a month, but lenders don't view that. Okay, so even though they may qualify for $500, maybe that isn't the best. Maybe it's $350 is more efficient.
Yeah, that makes a lot of sense.
Yeah, so I don't look at it from the standpoint of, hey, you qualified for this at 6, let's keep it the same at 3, and now your payment's $1,000 less. The overall picture is what I look at.
Earlier you talked a little bit about the short-term memory people have. Nobody remembers interest rates at 6%. Rates now will always be in the 3% range. Is the way people start to think.
6% is so good. 6% historically is amazing, by the way.
Yes. When I sent out an email to my clients when the 30-year fixed was like 5% or just dropped just below 5%, I'm like, I don't know if it's ever going to go lower. Unbelievable. And then a year later, it was like, now it dropped below 4%. And you're right, people do have short term, so they think it's going to stay like this forever. But if we look back in 10, 20 years from now, we're going to realize that these were unbelievable rates. But go ahead.
And people who are entering the housing market to buy a house have never seen, maybe for the first time, with all the pent-up demand over the last few years after the crash, they've never even heard of interest rates above 4%. Mm-hmm. So,
right.
It's like mind-boggling to them. You know, I started my career well after the rates at 13 or 14 or even as high as 18%. So those numbers are like mind-boggling to me from the 80s.
Well, here's always the interesting part, especially with what we're dealing with the market today. Okay, so you have buyers are coming in the market. It's an extremely competitive housing market, and buyers are having a hard time getting things under contract. But so buyers today are looking at this and say, well, I want to buy where things were last February or last January when it was still kind of a buyer's market thing. Even though interest rates were low, it wasn't that hot, so buyers had a lot of leverage. They want that now.
Yeah.
Okay, so they're kicking themselves for not doing anything. And the reality is this time next year, we're going to have the conversation that, wow, I want interest rates in the 3.5% to 4% range when they're going to be at 4.5% to 5%. And they're going to be kicking themselves for not either getting that refinance taken care of and not delaying on that, or getting through this tough time in the market, fighting for the home they want and getting it under contract so they have the home they want with really low interest rates. That will be the conversation next year. There's no doubt in my mind.
Hey, Ryan, I have one last question from my end. So when I've talked to people who may be underwater in their mortgage and try to ask them to talk about refinancing, and then they find out that their loan is not a Freddie or Fannie loan. Mm-hmm. Are there options out there for them? It feels like there aren't, but maybe you know some options available for people to refinance that don't have Fannie or Freddie.
Yeah, so I'll say it in a couple different ways. First is going to be a lot of people try to look up on the Fannie and Freddie website or go through a couple different sources to see if their loan is Fannie or Freddie. And what I've found is a lot of people, because the way you enter it on the websites to confirm is a little, if you have one thing wrong, it'll give you wrong data. Okay, right. So I definitely reach out to a lender who's familiar with that program and make sure that you have at least a brief consultation for starters, because a lot of people I find think they aren't when they really are. And number two, no, you can't today do anything that's underwater that's not Fannie or Freddie or FHA or VA. So VA, FHA, Fannie and Freddie, you can still refinance if you're insured by one of those institutions. Mm-hmm. Outside of that, they have a HARP 3 program that they're talking about in Congress that could come out, which is supposed to be geared for all those other people who are not owned by Fannie and Freddie, but are still making their mortgage payments on time and are in a good financial position.